It gives investors confidence that when the money comes, that founder is going to know what to do in order to capture that user and that payer and to encourage them to transact. And that's going to be the key to growing that company.
On today's episode, we are diving into one of the top subjects on every tech startup founder's mind, and that topic is fundraising. A lot of business fundraising advice out there treats founders as one group with one set of rules. Our guest today has a different view, one that has been built from working directly with over 200 founders. What she's discovered is that the due diligence bar isn't the same for every founder, and the gap shows up in one place: how founders prove they understand their customer, not just how they describe them. Listen on to learn what VCs are testing for beyond the pitch deck, how to tell the difference between actual customer evidence versus the founders who are just guessing on what that looks like. Our guest is Andrea Sommer, and she's the CEO and investor at Womankind Ventures. And with that, Andrea, welcome to Humanize.
Thank you so much. Thanks for having me.
Yeah, I'm excited to have this conversation. I want to kick this off with who you are and what your company is all about, and how did you get to where you are today?
Womankind Ventures is an advisory practice for startups. We focus on women-led companies, and we do a few different things. First, we work on helping founders fundraise and grow. And we also run an angel investment syndicate where we invest in the startups that we've worked with. So I have the privilege of wearing 2/3 hats when it comes to startups: one as an advisor, one as an investor, and one as a founder myself. So, and this is my fourth business. So I've built, fundraised myself. And so a lot of the advice that I give and what I see with my investor hat on are things that I experienced too as a founder at the earlier part of my career. So I really bring that experience and that expertise to my work with founders and to the diligence process that we do with investors. Part of what I do with investors too is teach them how to be more intentional about their investment decisions.
So you've been in the weeds, and now you're here to share your education and help other investors land the deals that they need. That's awesome. So you had said to me when we chatted prior, and as I just mentioned, the bar really isn't the same for every founder. A man is traditionally backed on his potential when a woman is backed on proof. Why is this even the case? And I would love to hear if you maybe have a specific deal where that gap showed up in the due diligence process.
Yeah, it shows up in nearly every diligence process. We, as our syndicate, only invest in women-led companies. And so we see only deals where the woman is backed, but we work with founders who are going out and fundraising from investors where that is not the case. And so the difference in the kinds of questions that they get asked is totally, there's a huge gap in the types of questions. And there's a huge gap in the type of proof and evidence that investors want to see from women versus from men. And so a big part of what we do is helping founders think about what is actually proof. What can you prove? And so an example that I can share with that is we've worked with a company, one of our, in the very beginning of when we started doing this work, that is a fashion marketplace. When they came to us, they had been fundraising for a little while, and they were hearing feedback from investors that this was a niche segment, that it was kind of a cute business, and they weren't getting very much traction across VCs at all. But when we evaluated the company, we saw something totally different. We saw a company that was operationally lean, that had incredible unit economics, much well above the industry norm for the type of sector that they were building, and a founder who was exceptionally well placed in a market that was really resilient, which is luxury fashion. And so we saw a super well performing business that we invested in, whereas other investors said, no, this business is too niche. We don't invest in fashion. And actually, it's not a fashion business, it's an e-commerce platform that happens to sell fashion. That company ended up being one of our top performing companies in our portfolio. We subsequently invested twice. We followed on twice on that investment. And they have been listed 2 years in a row as one of the UK's fastest growing companies. Eventually, VCs did catch on that this was a very operationally lean and well-performing company. But the way that they had to get there was to speak a very different language to investors so that investors could really see the unique way that women build and fundraise and be able to make that story palatable for the investor.
I just want to hammer in a little bit more, why do you think this is still the case? Because I'm curious if a man was presenting the same type of business. And I'm not that person who was oh, men this, women that, but this is actual factual information that you're seeing happening. Now, if a man were to present the same type of business, do you think that the outcome would have been different on the first initial conversation?
100%. And the data supports that. So there's two sets of research that I always lean on, which say that. One is the fact that only around 3% of women-led companies get VC funding, right? So that is a structural issue that is not, bad businesses. It's not bad pitching. It's literally a systemic decision-making difference that leans towards companies that are built by men versus companies that are built by women. And that is the case across companies, whether they are, in the fashion landscape or not. There are examples, for example, of companies in the femtech space. And this is an example that makes me a bit angry. There are examples of companies that look at kind of peer tracking data, and the company that in that space that has raised the most funding is a company that was founded by men, right? And there are lots of other companies that are solving that problem in similar ways that were created by women. And so, the problem itself that the company is solving is not the issue. The second piece of research that I always talk about is the promotion versus prevention question, which was an amazing seminal piece of research that talks about how investors, when evaluating women, look for risk mitigation questions. And they ask questions as a way of positioning the opportunity as though it's riskier. And they ask men promotion questions, which are all opportunity related questions, right? And so the kind of implication here is that women-led companies are already seen as riskier, and men-led companies are seen as more opportunity creating. And so the benchmark that women have to meet in order to even be considered has to overcome this inherent bias that they are seen as riskier. Why they are seen as riskier, I think, is a function of how women are seen in general in society. I think part of it is related to the assumption that women have childcare responsibilities and family care responsibilities, and that makes them less competent or less able to deal with the challenges of running a high growth company. I've had investors that have said that to my face. In fact, so it's not just a bias or a thing that women feel. It is something that investors do say. And I think that there are systemic issues that create this perception that women are not as capable of being women leaders as their male counterparts are. And this is true whether the investor is a woman or a man, which I find to be really interesting. It's not just men that express this bias. Women investors express this bias too.
Do you think it's gotten better over the past couple of years?
No, unfortunately, I don't think it's gotten better. I think the stats have stayed pretty much the same over the last 15 years. It's not really changed. I think the discourse has changed. It's more visible now. But I think the reality of what women experience when they're fundraising is still very much the same. I mean, we find the women that we work with have better success odds because we're teaching them how to play a totally different game, a game that is not set up for them, that is in fact rigged against them. And that helps create success. But that is a very microscopic advancement in an overall segment that is not really moving much. It's not changing much.
I hate that. I've even noticed too, and you worked with more founders than I have, but the majority of tech founders in particular are men. Have you seen the same thing?
I see a lot of women tech founders. I think that there is a perception that men are better placed to be tech founders, but I also think that when investors imagine what a tech founder looks like, they imagine a young white Stanford guy, and not a woman. And a woman looks like a very different version of a tech founder. And so when an investor is evaluating, they are pattern matching against things that they have seen before, against opportunities and companies that they have seen before. And when they pattern match a woman against what they see before, she just doesn't match the pattern, right? And that is part of the reason why this kind of exclusion happens. And so a big part of what we do and what we have to do much more of is to train investors to recognize the inherent pattern matching that they are using. And more importantly, we need to train them to recognize the different ways that women build, grow, and fund their companies, because it looks totally different. And if you start to look at the pattern that is unique to how women do it, you start to see the kind of diamonds in the rough much more clearly. But if you evaluate them based on the pattern matching for men, you won't see the opportunities and you'll miss out.
It's crazy. And I feel like you're taking on such a big undertaking here, but this is like what the world needs. Like women are really like looking for these opportunities and they need someone like you to lean on to be in their corner and, make it more of an even playing field. Hopefully a couple of years from now, we can get into that direction. I do want to talk more about the customer evidence because I have talked to founders and it's crazy how they'll get on a call with me and I'll be like, oh, like, what are your customers saying about this product? And they'll tell me, oh, well, I've talked to a couple of friends. And I'm thinking, okay, well, have you actually talked to people who could buy from you? But when they're so early, I don't know, just some of them aren't thinking, let me cold email people who could potentially be my customers and get their insights. And this isn't everyone. I've also worked with founders who started a company because they were the customer. And I know, being in marketing, how important it is to have this real customer evidence, because when you don't, you're kind of just guessing. And then when you're building a product and building a company, all from not having actual real insights, you could be building the completely wrong thing. So then when you're going into the investor pitch, it's all based on assumptions. So now I'm curious, from based on bouncing off of this, what you're seeing on the investing side. So when people or founders are actually doing this work where they're actually talking to people who could be their customer versus not, what does that show up as when they're going to seek out funding?
Yeah. It is practically impossible to fundraise as a woman if you haven't done a good job of understanding your customer. And that's because investors, when it comes to women, will back evidence of demand over product, right? So it is not useful use of time to start with building the product. It is a much more useful use of time to start with that evidence, capturing that evidence of demand. And that's two parts, right? One part is understanding who the user is and understanding who the payer is, right? And I think many founders conflate the two things and they don't realize that the user and the payer may be a different person, and that the investor cares more about who the payer is than who the user is, because investors care about the commercial opportunity that the business is presenting. So they don't necessarily care about the value creation that the company can make. They care about the value extraction. And that comes from the transaction that the payer makes with the company, right? That they transact and they bring some money into the company. So founders need to really think about carefully and understand who their payer is to make sure that they are serving that payer carefully and confirming not only that that payer says that they're willing to buy, but creating experiments that show that they're willing to transact, even if there are micro versions of what the actual transaction would look like when the product is actually built. And so the assumptions themselves are not the problem. It's the validation of the assumptions or the lack of validation of the assumptions that's the problem, right? So, but if a founder does a good job of figuring out who the user is, and more importantly, figuring out who the payer is, then they can build a plan for how to capture that payer and transact and encourage them to transact. And that's the key that we need to see in the fundraising process.
For people who are unfamiliar with that terminology, can you break down a little bit more of what the difference is between the user and the payer?
Yeah. So for example, if you have an app, right, that is, let's say you've created an app that's to help kids with their math skills, right? The user of that app is going to be the kid. The kid is going to be the one who's going to be interfacing with the app. They're going to be the one that are going to be learning through the information that app creates. But the person that buys the app is not going to be the kid. It's going to be the kid's parent, or maybe it's the kid's school, right? Or maybe it's the kid's tutor who is already helping them with their math. And the difference between the kind of strategy that you use to capture a parent versus a teacher or a school versus a tutor is totally different, right? So you, as the founder, you need to understand who is the lowest hanging fruit payer who is going to be buying before you understand. Like it's super important to make sure that you're making something that users will want, so that kids will want to use and that they'll learn from. But you also need to make sure that you understand who is the one who's going to buy that technology for the user. For example, if it's the school, then your activities and strategies need to be directed towards educating the school and convincing them to buy or encourage encourage the sale of this technology for their students. Versus if it's the parent, it's a different conversation. And so it's really important to understand the difference between the two. And it's a very nuanced conversation sometimes.
So you're having two different, or sometimes even more than two personas that you're going after. So now we're encouraging founders, no, like you're not just looking at who's actually using it, you're looking at who's the decision maker. So for example, like a lot of my experience has been B2B fintech, and it's like, oh, I'm targeting a CFO, but is the CFO actually using the product? No, the CFO is just making a lot of the buying decisions. So how do we reach the CFO? And then how do we reach the person who's actually going to be using it to make sure that we have the ongoing adoption for retention purposes? So looking at it from that angle is really important. Now, I think this is intimidating for a lot of founders, but if you want to be a founder, you got to put in the hard work. So are you recommending that they just cold email? What's like one of the best ways for them to get this information?
I think it's in today's world, we are very lucky that we have a plentiful amount of LLMs out there, and they can use their favorite AI to support this process and at the very early stages to create some assumptions that they then go out and test out with customers. I think it is absolutely good use of time for founders to cold email or find the places where their potential users and payers congregate. That's going to be helpful down the road when they actually want to reach them with a product that they want to sell, right? And from an investor perspective, it's so important to know that the founder knows how they're going to sell, right? Sometimes founders think, oh, I've built something amazing, it's going to sell itself, but actually nothing sells itself. You need to be actively selling to the right channel, through the right channels, and to the right people. And so that early work that a founder can do to figure out where their users and payers are located and how to reach them is extremely important for the fundraising process. And it gives investors confidence that when the money comes, that founder is going to know what to do in order to capture that user and that payer and to encourage them to transact. And that's going to be the key to growing that company. So unless they know how to do that, then it's going to be impossible for them to convince. There are other things that matter too. For example, conversion, right? So women are not socialized to convert, to treat the fundraising process like the sales process that it actually is. So figuring out that this is actually a sales process, that you have to actually actively navigate the investor through your sales funnel is a really good way that women founders can accelerate and improve their odds of successfully fundraising. So it's about doing the discipline of building a more investable business, understanding that business really, really deeply, particularly the things that are uncomfortable, like the financial aspects, and then using the right methodology for attracting and converting investors so that the process becomes efficient. And that's part of that is understanding the biases that you're going to be addressing and figuring out strategies for combating that. But part of that is also figuring out, like, what is the right playbook here? Who's the right type of investor for me, and not wasting time with investors that are not going to invest.
That makes sense. And to bounce off that, when you're determining who's the right investor, there's a time and a place where they don't even need investor money at all. I think there's just there's a connotation in the industry that VC money is like, you really made it if you're VC backed. And I've worked for VC backed companies and I think it's great, but I also think it's really not for everyone. I think what founders forget is like, you're actually giving up a piece of your company for that. So how badly do you really need it? With that being said, where would you say don't even go after VC money?
Yeah, I think that not every business is a VC backable business, and not every founder wants to be a VC backed founder. You know what I mean? Like, Some founders, and we've worked with lots of founders. I have two examples that are really interesting here. One was a founder who was building a company that was a spin-off of her PhD. And she's like, I don't feel comfortable having to re-earn some of the equity that I have spent 7 years in my PhD plus 3 years building commercially because an investor comes into the picture. And so she was like, nope, I do not want to go down the investment path. I would rather grow more slowly and organically through the sales process rather than to start to bring in venture funding, which accelerates my growth, certainly, but also creates a dynamic around control, which I'm not really comfortable with. Another example is a company that we work with more recently, and they realized that in order to meet the pace of growth that a venture-backed company, they absolutely could have done that. But in order to meet that growth, their personal objectives weren't going to be met. In this case, they were both women who had small children, and they were like, we don't really feel like we want to build. The reason why we became founders is to have more freedom and flexibility in our lives. And this is actually going to create the opposite. So for now, we would rather continue to growing the company organically. And at some point in the future, we may readdress. And I think those are perfectly great reasons why not taking investor money. I agree with you completely. There's a lot of people think that it's some sort of badge of honor or badge of amazingness that you get VC money, but it's just one route out of many that you can grow your company. You can grow organically. You can get angel funding. Debt is a great instrument as well that many founders sometimes overlook. Venture is a great way too, but it's not for everyone and it shouldn't be.
This is a lot of good stuff here today. So, which is one final thing I want to recap with. If I'm a founder listening to this today and I'm consider going after VC funding or not, what's one key takeaway that I could take with me on this journey to help me be successful?
Yeah, I would say that figuring out what kind of company you want to build first is the really important first step. Is do you want to build a company that grows incredibly fast, where that pressure is going to be on you for the next 5 to 7 years or even a little bit longer? Or do you want to build at the pace that you are comfortable with and growing in the way with the control that you have? First of all, decide which path you personally want to take. Then evaluate the path that is potential for your company. Not every company has the capacity to grow at venture scale. So figuring out, and ideally through your financial modeling process, can I build something that can grow to venture scale? Or are the dynamics and the levers that I can pull within this company not really possible, right? And if it's not possible, that doesn't mean you're building a bad business. It's still a great business, but it's just going to grow in a totally different way. But once you decide, yes, I want to do it, yes, I can, then that path becomes a possibility.
Final thing here, if people want to find you, what's the best way for them to reach you?
Yeah, I'm on LinkedIn, just Andrea Sommer on LinkedIn. And then our website is womankindventures.com.
Drop that in the show notes. Thank you.